This is ShadowQuant Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, August 10, 2026, and this is the New York pre-market. Now, let's get into it. The market is waking up with a distinct split in its personality. On one side, the Nasdaq and the mega-cap tech sector are surging, pushing the QQQ and S&P 500 toward their highest levels in nearly a week. On the other, energy and small caps are getting left behind, creating a divergence that is testing the breadth of this rally. With the VIX hovering near lows from yesterday's close, the question for today isn't just about how high the indexes can go, but whether the underlying breadth supports a sustained move. Let's look at the calendar. The market is currently digesting a quiet week for macro data, but the eyes are firmly on inflation and labor metrics later this week. On Thursday, August the 12th, we get the Consumer Price Index data. That is the key inflation print that will set the tone for the rest of the month. Following that, on Friday, August the 13th, we have initial jobless claims and Producer Price Index data. Retail sales also drops on Saturday, August the 14th, giving us a read on consumer spending. In earnings, a batch of smaller caps report today, but the real narrative is driven by the ongoing flows in the mega-cap tech names.
What to watch for in that CPI print on Thursday is whether the underlying stickiness in services is holding firm. If that data comes in hot, it could pressure the very yields that are currently supporting this equity rally.
Here is where we stand in pre-market trading. The S&P 500, tracked by SPY, is up 0.6% to $773.26. The Nasdaq 100, QQQ, is leading the charge with an advance of 1.17% to $723.03. The Dow Diamonds is slightly slower, up 0.2%. The Russell 2000, IWM, is also participating, up 1.11%. Let's talk about the headlines moving the needle. Intel, INC, is gaping down nearly 5% at $96.92 following the announcement of a $15 billion equity offering. That is a massive capital raise that is weighing on sentiment in the semiconductor space. The sentiment impact here is clear. When a legacy chip giant like Intel announces a $15 billion offering, it signals that the CAPEX cycle, which has been fueling the AI narrative, is facing liquidity constraints. It's not just about Intel, it's about the cost of capital for the entire hardware supply chain. Conversely, Vertex Pharmaceuticals, VRTX, is up 7.7% to $534. The catalyst is a new deal and data readout that is firing up traders.
From a fundamentals perspective, this is a classic catalyst-driven move. The market is rewarding the clinical data and the strategic partnership. It's a reminder that in biotech, specific company-level news can override broader sector headwinds. The flow is chasing the upside here, supported by the new deal structure.
And in the small cap space, we have massive moves. YJ is up 176%, and MB is up 137%, though volume is relatively low compared to the majors.
I want to flag the risk in those gappers. YJ and MB are up over 100%, but their volumes are nowhere near the megacaps. This is speculative froth. When you see these kinds of parabolic moves in low-float names while the broader market is consolidating, it often indicates a rotation of risk capital into speculation because the large-cap growth names are getting expensive. That is a warning sign for the breadth of the market.
Let's dive into the technicals. We have a clear divergence. Tech is strong, energy is weak. Let's start with the leader, QQQ, the Nasdaq 100. It's at $723, approaching the 5-day high of $728. Grid, what does the chart structure tell us about a break of that level?
The chart structure on QQQ is testing a critical juncture. We have a 10-day range that spans from $661 to $728. The price action over the last 4 days has been a steep climb. On Thursday, August the 7th, we closed at $723, having broken above the previous consolidation high. The key level to watch is $728. If we close above that on volume, we are looking at a breakout from a 4-day base. However, if we reject there, we have immediate support at the 5-day low of $716. The volume on the last 3 days has been confirming the move, so I am leaning toward the path of least resistance being higher, provided we hold the 5-day low.
I agree with the technical setup, but I am worried about the sentiment backdrop. The Fear and Greed Index is at 42, which is deep in fear territory. Usually, when you see a breakout like this on QQQ, you want to see the index rise above 50 into neutral or greed. The fact that price is rising while sentiment remains fearful suggests there is still a lot of unspent buying power from shorts covering. But if that sentiment doesn't catch up, the rally could be brittle. Let's look at the other side of the coin. SPY, the S&P 500. It is at $773, sitting just below the 5-day high of $776. CIPHER, how does the flow data look here?
The flow data is supporting the breakout attempt. Looking at the CFTC COT data, the commercials in the S&P 500 E-mini futures are at the 100th percentile, which is historically a bullish signal for positioning. It suggests that the smart money, the hedgers, are fully aligned with the long side. We are also seeing inflows into the consumer discretionary sector, consumer discretionary, which is up 1.49% today. That sector strength is providing the breadth that SPY needs to sustain a move above 776.
I have to challenge that bullishness on SPY. You are looking at the commercials, but you are ignoring the yield curve signal. The 10-year, 2-year spread is at 0.46 percentage points. It is flat. When you have a flat yield curve and equities are making new highs, that is a classic divergence. Historically, that setup often precedes a pullback. Furthermore, the VIX closed at 14.90 yesterday. That is a low volatility regime. Complacency is the enemy here. If SPY breaks above 776, it is likely to be a short squeeze, not a fundamental breakout. I am watching the credit spreads closely. If high yield spreads widen, this equity rally is in trouble.
I see the support structure on SPY though. The 10-day range is $729 to $776. We are in the top 10% of that range. The risk is a mean reversion back to the 270-day moving average, which is currently around $710. But for now, the trend is up.
Let's talk about the sector divergence. The technology sector, technology, is up 1.42%, while the energy sector, energy, is down 1.13%. NVDA, the bellwether, is in the news. Grid, what is the technical posture of the technology sector?
The technology sector is showing a strong relative strength pattern. It has outperformed the SPY for the last 5 trading days. The chart on the technology sector shows a clear higher-low structure. We are currently at $187. The key resistance is at $195, which was the high from last week. If the technology sector breaks that, we are looking at a continuation of the trend. The volume on the technology sector move today is heavy, suggesting institutional accumulation.
The fundamentals behind the technology sector are driven by the earnings narrative. We have 5 consecutive quarters of year-over-year earnings per share growth for NVDA. The earnings per share is up 121% year-over-year. That is not just growth, that is an acceleration. The market is pricing in continued dominance in the data center space. The flows into the technology sector are not just speculative. They are backed by the actual earnings revisions.
But the sentiment is getting crowded. The news sentiment for NVDA is bullish, with 46 articles in the last day. When every article is bullish and the Roman 4 rank is at 99%, that is a sign of maximum enthusiasm. The put/call ratio for NVDA options is extremely low, meaning nobody is hedging. That is a fragility point.
Exactly. The fragility is in the valuation. The Roman 4 rank for NVDA is at 99%. That is the highest it has been in a year. The market is pricing in perfection. If NVDA misses on guidance or provides any hint of slowing demand, the short squeeze unwinds. The energy sector is down 1.13%, and it is at one of the lowest points in its 10-day range. That is a defensive move. Money is rotating out of cyclical energy and into growth tech, which is a risk-on trade, but it is a very narrow trade.
Let's look at the laggards. The energy sector is down 1.13%. Is this a buying opportunity or a sign of broader weakness?
From a technical standpoint, the energy sector is testing support. The 10-day range for the energy sector is from $54 to $59. We are currently at $57.50. That is right in the middle of the range. The moving averages are flat. I don't see a breakdown yet, but I don't see a breakout either. It's consolidating. The relative strength line against SPY is declining, which means energy is underperforming the market.
The fundamentals for energy are mixed. We are seeing a rotation away from energy stocks as interest rates remain elevated. The cost of capital for exploration is high. However, the COT data shows commercials are at the 100th percentile for crude oil, which is bullish. So the smart money is long oil, but they are shorting the equity exposure. That is a divergence.
I think the underperformance in the energy sector is a warning sign for the broader market. Energy is often the leading indicator for inflation expectations. If energy is weak, it suggests the market does not believe in a reflationary trade. Without reflation, the equity rally loses its tailwind. I am watching the spread between oil and the SPY. If oil continues to lag while SPY rises, it is a sign that the rally is driven by low rates and low inflation, which is a fragile equilibrium.
Let's look at consumer discretionary, which is up 1.49%. This is the strongest sector today. What is driving this?
This is being driven by the earnings momentum in the retail and entertainment sectors. We have positive earnings surprises in names like Netflix and Amazon. The flow data shows net inflows into the financial sector and consumer discretionary sectors. The consumer is still spending, and the earnings data supports that.
The sentiment in consumer discretionary is improving. The II survey shows a shift in bullishness among retail investors. They are starting to buy the dip in their favorite brands. This is a healthy sign for sustainability.
The chart for consumer discretionary is breaking out of a flag pattern. We are at $119. The breakout is on high volume. The next resistance level is $125, which was the high from early July. If consumer discretionary holds above 120, we are looking at a trend continuation.
I am still concerned about the breadth. The A/D ratio is 2.7, but the trend is falling. That means the number of advancing stocks is falling even though the indices are rising. That is a classic divergence. The leaders are propping up the index, but the majority of stocks are weak. That is a recipe for a sharp pullback if the leaders falter.
Let's bring in the small caps. IWM is up 1.11% to $301. Grid, what is the structure there?
The Russell 2000 IWM is holding above the 5-day low of $297. We are currently at $301. The trend is up, but it is slow. The volume is lighter than on the large caps. I am watching the $295 level as key support. If that breaks, we are looking at a test of $290.
The fundamentals for small caps are mixed. The credit spreads are wide, which hurts small cap borrowing. However, the domestic focus of many IWM companies could be a tailwind if the domestic economy remains resilient.
The sentiment in small caps is still very weak. The fear and greed index is driven by large caps. Small caps are still in a fear regime. Let's look at Intel again, INTC. It is down nearly 5%. Grid, is this a breakdown?
Intel is gapping down at $96. The pre-market low is $96. The support level is $92, which was the low from last week. If 92 holds, it could be a bounce setup. But if it breaks 92, we are looking at a slide to $88. The volume is heavy, which suggests institutional selling.
The fundamentals are under pressure. The $15 billion equity offering is dilutive. It increases the share count and raises questions about cash flow. The earnings guidance for the next quarter is likely to be cautious.
This is a sector-wide issue. The semiconductor space is crowded. When a legacy name like Intel needs to raise $15 billion, it suggests that the cash flows from the AI boom are not yet reaching the entire supply chain. It is a risk to the tech rally.
Let's wrap up with Apple. It is down slightly. What is the read? The sentiment for Apple is bearish, with 26 articles and a negative sentiment score. The market is waiting for the next product cycle.
The earnings data for Apple is mixed. Revenue was $10 billion, but growth is slowing. The flow data shows net outflows from Apple.
The chart for Apple is below its moving average. It is in a downtrend. The support is at $108.
Apple is a proxy for consumer spending. If Apple weakens, it confirms the bearish breadth we are seeing.
Apex tie it all together. We have a strong tech rally, weak energy, and mixed breadth. What is the equity outlook?
The data presents a complex picture. Pulse, you noted the fear and greed index is at 42, suggesting fear, yet the indices are rising. That is a positive divergence for the short term, but it requires sentiment to turn neutral to sustain the move. Grid, you identified that QQQ and SPY are testing key resistance levels at 728 and 776, respectively. A break above those with volume is bullish, but a rejection would be a significant bearish signal. CIPHER, the fundamentals are strong in tech and consumer discretionary, with earnings growth supporting the rally. However, SPECTER, you rightly pointed out the yield curve is flat and the VIX is low, which creates a risk of a sudden volatility spike. My assessment is that the market is in a risk-on regime, but it is fragile. The leadership is narrow, focused on tech and discretionary. The key is to monitor the breadth. If the A/D ratio starts to rise while the indices rise, the rally is healthy. If the indices rise and the A/D ratio falls, we are in a trap. For now, the data supports holding the long positions in tech and discretionary, but with tight stops below the 5-day lows.
To summarize today's analysis, the market is showing strength in technology and consumer discretionary, with QQQ and SPY approaching key resistance levels. However, the breadth is weak, and the yield curve is flat, creating a risk of a pullback. Investors should monitor the breakout levels in QQQ and SPY and watch for a deterioration in the A/D ratio. Let's hear your weekly calls for Friday's close. The sentiment is turning positive as the indices break out, but the fear and greed index is still low. I expect the sentiment to catch up by Friday. My weekly call, SPY bullish, target $780 by Friday.
The technical structure on QQQ is bullish with a breakout above $728 likely. I am watching the support at $720. My weekly call, QQQ bullish, target $735 by Friday.
The earnings momentum in tech and consumer discretionary supports the rally. The flow data is bullish. My weekly call, consumer discretionary bullish, target $125 by Friday.
The yield curve is flat and the VIX is low. I expect a volatility spike. My weekly call, SPY bearish, target $760 by Friday.
I am synthesizing the views. The technical breakout is strong, but the fundamental risks are present. I am leaning toward the bullish case, but with caution. My weekly call, QQQ bullish, target $730 by Friday.
That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.